incurring just 2 percentage points in trading costs instead of 0.2%. Barber and Odine's group paid 6 or 7%. Professors Barber and Odine don't have a really good reason why so many investors commit investing suicide. They say they think people trade too much because they're overconfident. That's certainly plausible. Barber and Odine give a succinct encapsulation of their research. Our central message is that trading is hazardous to your wealth. Professor Burton G. Malkiel of Princeton would agree. In a 2013 article in the Journal of Economic Perspectives, he observed that for actively managed funds, fees and other expenses have risen substantially, not just in total, but even as a percentage of assets managed. Professor Malkiel says that doesn't make sense. Investment advisors do incur legitimate expenses, of course. Malkiel gives a long list, including general market analysis, industry analysis, accounting, reporting requirements. You'd think those would decline as a percentage of assets if a fund grows, though, wouldn't you? However much it costs to analyze the general market, it shouldn't cost twice as much if the size of my fund doubles. A bigger fund needs more securities analysts, sure. But again, would you need more than twice as many analysts to serve a fund that's twice as large? It just doesn't sound right. Although they may be hidden, transactions costs are always there. Somebody has to match your order with a counterparty, somebody has to record the trade, and somebody has to transfer the securities and funds. You can't expect those guys to work for free. You might pay an explicit commission, which is a fee paid to your broker for making the transaction. On stocks, the most common fee is the bid-ask spread, or just the spread. Think of the spread as the dealer's markup. A car dealer or a grocer buys at one price and sells at a higher price, right? The difference goes toward his profit. For stocks, the dealer buys at the bid price and sells at the ask price, and the spread is the difference. If you make a round-trip trade, then you're going to pay the full spread over your two transactions. A dealer charges a spread for another reason besides just making a transaction for you. He's taking a lot of risk by holding shares in inventory so that he'll have them when customers want to buy. He won't do that for free. They say that nothing is certain but death and taxes. You, my friend, are going to pay taxes on your stock investments. So let's take a look at how they affect your gains and losses. If you're like almost all other investors, you'll want to pay as little as possible to the government and keep as much as possible for yourself. The tax code contained just 11,400 words in 1914, 1 year after the Constitution was amended to permit the federal government to levy an income tax. It didn't stay that way. Forbes contributor Kelly Phillips Erb said that the code was up to about 4 million words by January 2013. That's about 4 times as long as all of the Harry Potter novels combined. And you know what? That vastly understates the complexity of the U.S. tax system. The code itself is just the law that tells the IRS what to do. The IRS has to devise regulations to put the law into practice. I doubt anyone really knows how many words are in the regulations. And the story gets worse. In the last 15 years or so, Congress has passed and the president has signed changes into the tax law at the rate of about 1 per day. Nina E. Olson, who heads the Taxpayer Advocate Service, told Congress that U.S. taxpayers spend about 6 billion hours, or the equivalent of 8,758 lifetimes, completing tax returns each and every year. And next year we'll do it all again, another 8,758 lifetimes. Don't ask me if that includes time spent on state and local taxes. I really don't want to think about it. Let's admit it,